Korea's venture investment market posted its second highest quarterly total on record in Q1 2026, with new venture investments reaching 3.3 trillion won, a 24.1% jump year-over-year, trailing only the 2022 boom. New venture fund formations also surged 30.7% to 4.4 trillion won, numbers strong enough that calling this a boom era would not be an overstatement on the surface. But a closer look at the data reveals an uncomfortable truth. The primary engine behind this recovery is not private capital, it's government policy finance. Policy finance contributions surged 82.0% year-over-year in Q1 to 1.0606 trillion won. The Korea Fund of Funds posted an extraordinary 177.9% increase, while the Korea Growth Investment Corporation was up 221.0%. A substantial share of the headline, 30.7% fund formation growth, traces directly back to government and policy capital expansion. To be clear, private capital remains the dominant force. Private sector contributions totaled 3.3045 trillion won, accounting for 75.7% of total fund formation still. The majority in both absolute size and share, with 19.8% growth of its own. But compared to Q1 2022, when private capital accounted for 85.6% of the market, the structural drift toward greater policy finance dependency is hard to ignore. Perhaps more telling is what's happening inside the private sector figures. Venture capital firms' own direct contributions, the money VCs put in from their own balance sheets, actually declined 1.2% year-over-year to 369.4 billion Korean won. In other words, while total private capital has grown, the firms that are supposed to be leading risk-taking in the ecosystem are increasingly riding the coattails of policy money, rather than opening their own wallets. This shift in the funding supply structure is actively deepening the polarization of the startup ecosystem. StartupRecipe's March analysis why escaping the valley of death is getting harder flagged this divergence in Q1 data. Despite the headline growth, funding for early-stage companies is drying up, while capital concentrates in late-stage, already validated firms. The government's own Q1 statistics confirm the same pattern. Investment in startups aged 3 years or younger fell 9.5% year-over-year to 667.5 billion won. Meanwhile, investment in companies with more than 7 years of operating history surged 35.9% to 1.8741 trillion won. Korea's startup investment market today operates on a model where government primes the pump and private capital follows, with capital concentrating almost exclusively in proven late-stage bets. It looks like a boom, and in many respects it is. But whether recovery led by policy finance, rather than a genuine expansion of private risk capital and early-stage funding, can build a truly sustainable investment ecosystem remains an open question.